January 2026. A number flashes across Bloomberg terminals worldwide. 682.6 billion. China's US debt holdings have crashed to a 17-year low. And here is what nobody is telling you. Beijing is selling these bonds at massive losses. Billions in losses. They are lighting money on fire just to get out. You do not sell at a loss unless you know something worse is coming. This is not portfolio rebalancing. This is not market timing. This is a financial divorce. And the consequences are already hitting your wallet. Your mortgage just got more expensive. Your car loan interest rate just jumped. Your credit card APR is climbing. All because China decided to walk away from $1 trillion relationship that held the global economy together for 20 years. The question you should be asking is not why China is selling. The question is, what do they know that you do not? Because when the world's second largest economy dumps US debt at record losses during high interest rates, they are not making a mistake. They are making a calculated bet, and that bet is against the dollar. Before we break this down, hit that subscribe button and join the Wealth Forum. We expose the financial earthquakes before they hit your bank account. Turn on notifications, because what comes next will change how you protect your money forever. Now let's talk about how we got here, and why this $682 billion exit is just the beginning. Let's go back to 2013, the year China held more American debt than any country in history. $1.31 trillion in US Treasury bonds. That is trillion with a T. To put that in perspective, that is more than the entire GDP of Mexico, more than the GDP of Australia. China was not just America's largest trading partner, it was America's banker, the hidden engine financing everything. Here is how the system worked. You bought Chinese goods, cheap electronics, clothing, toys, furniture. Every dollar you spent did not stay in China. It circled right back to America in the form of Treasury bond purchases. China took those dollars and bought US government debt. This kept interest rates artificially low. It kept mortgages cheap. It kept the American economy humming. It was the most elegant financial arrangement in modern history. America consumed, China produced and lent, and the whole world benefited from the stability. But this was not charity. This was strategy. China needed a stable dollar to store its wealth. A weak dollar would destroy the value of their reserves overnight, and America needed China's appetite for debt to fund massive deficits without triggering inflation. It was mutual dependency, a financial marriage where both sides needed each other to survive. For 20 years, this system created cheap capital. Your 3% mortgage in 2012. Thank China. Your low-interest car loan? Thank China. Corporate America borrowing billions to expand? Thank China. Every corner of the US economy was quietly subsidized by Beijing's willingness to keep buying bonds. Most Americans had no idea, but the entire financial system was built on this silent promise. By 2024, that promise was already cracking. Trade wars, technology bans, geopolitical tensions. The relationship was deteriorating, but nobody expected what came next. Nobody expected China to walk away at a loss, because in finance, rational actors do not accept billions in losses unless they see something catastrophic on the horizon. And in January 2026, the world found out exactly how catastrophic China thought it was going to be. Now let's talk about the mechanics. How does a country dump $688 billion in debt? And what happens when the world's largest creditor suddenly becomes a seller? Here is how bond markets work. And once you understand this, the entire crisis makes perfect sense. Step 1 is the inverse relationship. When interest rates go up, bond prices go down. Always. No exceptions. Think of it like a seesaw. Federal Reserve raises rates. Existing bonds lose value. This is not theory. This is mathematical law. And right now, the Fed has rates at their highest level in 23 years. That means every Treasury bond China bought between 2008 and 2022, when rates were near zero, is now worth a fraction of what they paid for it. Here is a real example. China buys a 30-year Treasury bond in 2020 at 1.5% interest. Today, new bonds are being issued at 4.5%. Why would anyone buy China's old bond at 1.5% when they can get a new one at 4.5%? They would not. So the price of that old bond crashes. China bought it at $100. Today it is worth maybe $70. That is a 30% loss. Multiply that by hundreds of billions of bonds, and you start to see the scale of the damage. Step 2 is the liquidation cascade. When China sells, it floods the market with supply. Basic economics. More supply than demand equals lower prices. So not only are bonds losing value because of high interest rates, They are losing even more value because China is dumping them all at once. It is a double hit, and it creates a feedback loop. Prices fall. Other investors panic. They sell too. Prices fall further. The whole market starts to spiral. Step 3 is the global ripple effect. US Treasury bonds are the foundation of the entire financial system. They are used as collateral for loans. They sit in pension funds. They back insurance companies. They are in every major bank's portfolio. When their value crashes, it destabilizes everything connected to them. Regional banks that bought bonds in 2020 are now sitting on massive unrealized losses. If depositors panic and withdraw their money, those banks have to sell bonds at a loss to raise cash. And that is exactly how bank runs start. Step 4 is the interest rate spike. Here is the brutal part. When China stops buying US debt, someone else has to. And that someone demands higher interest rates to compensate for the risk. The US government still needs to borrow trillions every year to fund deficits. If China is not buying, yields have to rise to attract new buyers. Higher yields mean higher borrowing costs for everyone. Your mortgage rate jumps. Car loans become more expensive. Credit cards spike. Corporations pay more to borrow. And the entire economy slows down because money is now expensive instead of cheap. Step 5 is the Fed's impossible choice. The Federal Reserve is now trapped. If they let interest rates stay high, the economy tanks. Businesses fail. Unemployment rises. Recession hits. But if they lower rates to stimulate growth, they risk reigniting inflation. Remember, inflation is still sticky at 4 to 5%. Lowering rates now would send prices skyrocketing again. So the Fed is stuck between recession and inflation. Two terrible options with no good way out. This is the mechanics of China's exit. It is not just a sale. It is a systematic unraveling of the financial architecture that has supported American prosperity for 2 decades. Every bond sold is another brick removed from the foundation, and the cracks are starting to show everywhere. Now let's talk about the crisis, because this is not a future threat. This is happening right now, and the breaking point is closer than anyone wants to admit. Here is the moment that changed everything. December 2025, China's holdings dropped below $700 billion for the first time since 2009. But the real shock was not the number. It was the cost they were willing to pay to get out. Financial analysts calculated the losses, somewhere between $50 and $80 billion. $50 billion, gone, just to exit the position. In a normal market, you wait for rates to fall and prices to recover. You minimize losses. You act rationally. China did the opposite. They sold everything, fast, at terrible prices. And they did not care. This is when Wall Street knew something was deeply wrong. Because countries do not burn $50 billion unless they believe staying in the position will cost them far more. What did China see that spooked them so badly they were willing to take? Record losses just to escape? The answer is sanctions. In February 2022, the United States and Europe froze $300 billion in Russian central bank reserves overnight. $300 billion. Gone with the stroke of a pen. Russia thought their foreign reserves were safe. They were wrong, and China watched. Beijing saw exactly what the US could do to foreign-held assets during geopolitical conflict. And they made a decision. Never again. If tensions over Taiwan escalate, if the US imposes sanctions, if the relationship deteriorates further, China's Treasury holdings could be frozen just like Russia's. All $682 billion. Locked, unusable, weaponized. That is not a theoretical risk. That is a clear and present danger. And Beijing is not waiting around to find out. But the exit strategy goes deeper than just avoiding sanctions. China is converting paper promises into physical power. Since December 2023, the People's Bank of China has been buying gold for 26 consecutive months. 26 months. No breaks, no pauses. They have amassed over 2,300 tons of physical bullion. Every $1 billion they pull out of US treasuries gets partially redirected into gold bars sitting in vaults in Shanghai and Beijing. Why gold? Because gold has no counterparty risk. It cannot be frozen. It cannot be sanctioned. It cannot be devalued by a foreign government. It is absolute wealth. It exists outside the dollar system, outside the reach of Washington. And in a world where financial assets can be weaponized at any moment, gold is the ultimate insurance policy. China is also building alternatives. In January 2026, the BRICS nations launched the unit, a digital currency backed 40% by gold. This is not Bitcoin. This is not speculative crypto. This is a state-backed settlement system designed to bypass the dollar entirely. Oil trades, mineral exports, manufactured goods, all can now be settled in the unit without touching US banks or the SWIFT network. Every transaction that moves to the unit is one less transaction that needs dollars, and that erodes American financial leverage one deal at a time. This is the crisis. Not that China is selling, but what China is building to replace it. A parallel financial system where the dollar is optional, where gold is king, where US sanctions have no power. This is not panic. This is preparation. And it is happening faster than anyone predicted. And here is the terrifying part. Other countries are watching. Japan holds over $1 trillion in US debt. They are watching. The UK holds $700 billion. They are watching. Saudi Arabia holds $135 billion. They are watching China exit at a loss and ask themselves the same question. Are we next? Should we be doing the same thing? If even 10% of foreign holders follow China's lead, the entire Treasury market collapses. Interest rates would spike to double digits. The US government would be unable to borrow. Deficits would become unsustainable. And the dollar's role as the global reserve currency would be over. Not in 20 years, in 20 months. This is the turning point. The moment the global financial order that has existed since 1944 begins to crack. China fired the first shot, and every central bank in the world is now deciding whether to follow. Now let's talk about the consequences. Because the fallout from this exit is already destroying wealth across America, and it is only going to get worse. Here is what China's $682 billion exit means for you, not in theory. In your actual life, consequence one is mortgage rates. The average 30-year mortgage rate in America was 6.8% in January 2026. That is double what it was in 2021. Why? Because Treasury yields spiked when China started selling, and mortgage rates track Treasury yields. If you bought a $400,000 house in 2021, at 3%, your monthly payment was around $1,700. That same house today at 6.8%, your payment is $2,600. That is an extra $900 a month, $10,800 a year, just because China dumped bonds. Consequence two is inflation. The Federal Reserve is trapped. They cannot lower rates without reigniting inflation. But they also cannot keep rates high without crushing the economy. So they are trying a third option. Yield curve control. The Fed is buying treasuries directly to keep long-term rates from spiking too high. But buying treasuries means printing money. And printing money means inflation. Groceries are up 32% since 2020. Gas is up 40%. Housing costs are up 65%. And wages are up 12%. You cannot math your way out of that. Consequence three is the banking crisis. Regional banks are sitting on hundreds of billions in unrealized losses from bonds. They bought at low rates. Silicon Valley Bank collapsed in 2023 for exactly this reason. They bought treasuries at 1%. Rates went to 5%. Bond values crashed. Depositors panicked. Bank run. Collapse. That same risk exists today in dozens of regional banks across America. And if China keeps selling and rates keep rising, more banks will fail. Consequence four is the credit crunch. When Treasury yields rise, so does the cost of all other borrowing. Credit card rates are now averaging 22%. Car loans are at 8%. Corporate borrowing has slowed to a crawl. Small businesses cannot get loans. Expansion stops, hiring freezes, and the economy grinds slower and slower because capital, the fuel that makes everything run, is now scarce and expensive. Consequence five is the multipolar shift. The dollar has been the world's reserve currency since 1944. That gave America extraordinary power. We could print money and export the inflation to the rest of the world. We could sanction countries and cut them off from the global financial system. We could borrow trillions at low rates because everyone needed dollars. But that era is ending. The BRICS unit, gold-backed trade, China's exit, these are all signs of a world moving away from dollar dominance. And when the dollar loses reserve status, America loses the ability to run deficits for free. We lose the ability to sanction without consequence. We lose the financial leverage that has defined global power for 80 years. This is not a recession. This is a restructuring. The global financial order is being rewritten, and America is no longer the only author. The consequences are not theoretical. They are personal. They are immediate. They are inescapable. And they are accelerating faster than most people realize. So here is the lesson. China's $682 billion exit is not just a market event. It is a signal, a warning, a declaration that the rules have changed. The era of cheap American debt is over. The era of unchallenged dollar dominance is ending. And the financial system that has powered prosperity for decades is breaking apart in real time. The people who understand this are already moving. They are buying gold. They are diversifying into hard assets. They are getting out of long-term bonds and into things that cannot be printed, frozen or devalued. Because when the world's largest creditor walks away at a loss, it is not a mistake. It is a message. The question is whether you are listening. Because the next wave is coming. And when it hits, it will not ask if you were paying attention. It will just take everything you did not protect. So here is what you do. If this video changed how you see the global financial system, if it made you realize that the stability you assumed was there is actually crumbling, then smash that like button. Subscribe to the Wealth Forum, turn on notifications. Share this with anyone still holding all their wealth in dollars and bonds. Because the next video breaks down exactly how to protect yourself when the dollar loses reserve status. And you do not want to miss it. But before you go, leave a comment. Tell me this. Do you think the dollar can survive this? Or is the multipolar world already inevitable? Because I genuinely want to know where you think this is heading. The $682 billion exit is not the end. It is the beginning, and your financial future depends on how you respond.